Banks are financial institutions that trade with money. Their main activity is to collect funds from depositors and lend those funds to others. To do this, they use financial products which are standard contracts written by the banks, leaving clients little room to negotiate. Banks operate in two main ways: by collecting money and by lending money. When they collect money, they offer passive products such as checking accounts, saving accounts, and time deposits. Through these, clients become suppliers of money to the bank. When banks lend money, they offer active products, loans, credits, or lines of credit. In this case, the bank becomes the supplier of money and the client becomes the debtor. Like any business, banks earn profit by lending money at a higher rate than they pay for deposits. This price of money is the interest rate. The rate they pay to depositors is the passive rate, while the rate charged on loans is the active rate. The difference between them is the spread or intermediation margin, which represents the bank main income. Banks also earn money from commissions and fees for services such as transfers, credit cards, and account maintenance. Depending on the needs of each borrower, banks provide different financial products. For business that need quick cash, banks offer credit lines or working capital loans. To collect payments early, they offer discounts lines, invoice advance, or factoring. To delay supplier payments, they offer confirming service, and to buy long-term assets, banks offer investment loans or leasing. These are the most common financial products, and altogether they define how banks capture, lend, and profit from money. A bank is a company that collects money from clients and lends it to others, but there are several kinds of banks with different purposes. Public banks are managed by the government. Their goal is to promote economic stability and social development. Examples include the Central Bank of Argentina or the Central Bank of Bolivia. Private banks belong to private investors and focus on generating profit, like HSBC or JP Morgan. Mixed banks are managed by both the state and private shareholders. Specialized banks serve specific sectors such as agriculture, industry, or housing. Central banks stand above all others. They regulate the financial system, control interest rates, and issue currency. And second-tier banks redirect financial resources to strategic areas of the economy. For example, infrastructure or agriculture. These different types of banks work together to move money through the economy, each one with a unique role. One of the most important events in recent financial history is the subprime mortgage crisis of 2008. In the early 2000s, after the dot-com bubble burst, the US economy entered recession. To stimulate growth, the Federal Reserve lowered interest rates to nearly 1%. Borrowing became cheap and millions began buying homes. Investors were looking for profit, so financial institutions started creating new financial products, mortgage-backed securities. By bundling thousands of home loans together and selling them to investors, at first it worked. Housing prices kept rising and everyone was making money, but some banks ran out of reliable borrowers. Instead of stopping, they began offering subprime mortgages, risky loans to people with poor credit and unstable incomes. The assumption was that even if borrowers couldn't pay, banks could always sell the house at a higher price. However, when borrowers began defaulting, the system collapsed, more homes went on sale, prices started falling, and borrowers walked away from their loans. Banks were left holding thousands of worthless mortgages that no one wanted to buy. Major institutions like Lehman Brothers went bankrupt, and the crisis spread worldwide. Millions lost their homes, unemployment rose, and the global economy entered a deep recession. The crisis revealed how dangerous excessive risk can be and led to stronger regulations such as Basel III and the Dodd-Frank Act. On the other side of the financial system, we find microfinance, a small financial service for people without access to traditional banks. Microfinance provides more loans to low-income individuals or families, helping them cover basic needs, start small business, or face emergencies. These services are essential in developing countries. For example, in Bangladesh, the Grameen Bank, founded by Mohamed Yunus, gave small loans to poor entrepreneurs, many of them women. These loans allowed them to open small shops, workshops, and local business, creating thousands of jobs and reducing poverty. Similar examples exist in Latin America, such as Banksol in Bolivia and Mi Banco in Peru. Microfinance is not only about lending money, it's about promoting inclusion and independence. It has shown that even small financial support can generate big social change.